Welcome back, folks. The CFTC, the Commodities Futures Trading Commission, has given UBS the ability to hide all of the derivatives and swaps that they inherited from the collapse of Credit Suisse, which of course was inherited from the collapse of Archegos. What could go wrong if these swaps were disclosed? A massive exposure of hidden short positions, aka synthetic shorts. Many legacy total return swaps or equity swaps mirror short positions in stocks like GameStop, AMC, the silver ETF SLV, and many other heavily shorted names, especially the ones that were made position close only in 2021, over 50 different stocks. And the disclosure here, if it were to take place, would reveal massive hidden short exposure that is still lingering in the system, by the way, folks, far beyond what's public reported via short interest. And this would validate, of course, retail suspicions that synthetic positions have been suppressing prices, fueling a massive wave of renewed buying and attention to these stocks. Obviously, guys, if this was disclosed, it would ignite another short squeeze or gamma squeeze event, as traders and funds would absolutely pile in, anticipating massive forced unwind pressure. We're talking massive counterparty risk chain reactions. These swaps are interconnected between prime brokers. That means banks, hedge funds, etc. And if one party is overexposed and can't cover, it could cause margin calls, fire sale liquidations, and absolute market chaos, contagion across institutions, like what happened with Archegos and Credit Suisse and Melvin Capital, and so on and so forth. So I'm going to explain to you here in detail. I put together this thread, and I'm going to explain it to you even more in depth. What is this total return swap? A total return swap allows a hedge fund to gain synthetic exposure to a stock without owning it directly. What's going on? Steve Maynard says, hey, boss, topped up on Lit Exchange today. Thanks for all you do. Welcome, my friend. I'm glad to be your partner in that. Instead of owning the stock directly, the prime broker, or in this case, the bank, same thing, owns the stock and gives the fund the economic performance and gain, loss, and dividends. And we've got an example. You want to say hi? Say hello.
Hello.
All right. We got an example. Let's say hedge fund A enters into a swap with Credit Suisse. Credit Suisse buys 10 million shares of GameStop. And then hedge fund A gets the gains and losses from that position. And the Credit Suisse would have to hedge their exposure, often by shorting the same stock and creating market pressure. And the end result is synthetic short interest that is created without any short sale needing to be reported to FINRA. This is one of many ways in which short interest is hidden from the stocks. So when you see the short interest on stocks, you have to know, and if you don't already, I'm telling you that it's fake. It's not real. It is massively higher than what it is in most cases, than what you're seeing. The hidden short problem. Why is the CFTC giving them the ability to hide all of these swaps? And they are. You can see here they're saying that the CFTC issued a no-action letter regarding the CFTC's swap clearing and uncleared swap margin requirements. This letter is in connection with the court-supervised transfer of certain swaps from Credit Suisse to UBS London branch following the merger of UBS and Credit Suisse Group. These legacy swaps were entered into prior to the relevant compliance dates for the CFTC's margin and clearing requirements, and therefore were not subject to such requirements prior to this court-supervised transfer. The no-action letter states, in connection with such transfer and subject to certain conditions, MPD will not recommend the Commission take an enforcement action against certain of UBS AG London branch's swap dealer counterparties for their failure to comply with the CFTC's uncleared swap margin requirements for such transferred swaps, and blah, 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 will not recommend the Commission take enforcement against them or their counterparties for their failure to comply with the swap clearing requirements of such transferred swaps. This just came out yesterday, and this is extremely important because they're literally saying that the hidden short problem is And the disclosure is incredibly dangerous. The public short interest is incomplete. Traditional short interest only reflects reported short sales, and they are self-reported by the market participants. You guys saw in a video I did day before yesterday that JP Morgan hid over 77 billion short positions over a period of about 17 years, from 2007 through 2024. Synthetic shorts via total return swaps, options, and other sorts of bullet swaps, etc., aren't included in those figures because those are ISDA contracts, and ISDA contracts do not reflect in the short interest of stocks. If the public knew the real scale of these bearish bets, especially in meme stocks like GameStop and AMC, it would trigger market panic and frenzy. Disclosure here would reveal the size of legacy positions in stocks like GameStop, AMC, Bed Bath & Beyond, etc., BlackBerry, SLV, and who holds them, which hedge funds and prime brokerages, and how deeply some of these banks like Credit Suisse pre-merger, now UBS, were entangled in these toxic exposures. This is going to be a chain reaction, systemic risk from disclosure, folks. That's what we're looking at right now. We're talking forced unwinds and liquidity crisis. If the counterparties are revealed to be heavily short or synthetically exposed, they could face margin calls from the clearing firms, from the banks, from their other participants, the broker-dealers, rapid forced buybacks to close their positions, massively spiking stock prices, and huge collateral shortfalls. This would trigger liquidation of unrelated assets, fire sales, and this is how Archegos imploded. Swaps were not properly collateralized. When the prices moved, the banks were caught in the wrong position. We're talking contagion across institutions, folks. If one big player here, like UBS, via the Credit Suisse legacy exposure, is forced to cover, other banks with similar swap exposure would also have to start covering. Market makers would pull liquidity, spreads would widen, and there would be massive fueling of volatility. The systemic exposure here, guys, in a lot of these thinly traded and volatile names would absolutely blow out pricing. It would be a complete reignition of meme stock volatility, not seen since when Roaring Kitty came back, and before that, 2022 and 2021, and multiple occasions. June of 2021, when AMC ripped and roared all the way up to $79 a share, and when GameStop in January of 2021 ripped into the hundreds of dollars a share, the public realization of real synthetic short interest would send meme stocks parabolic again, without question. Retail would re-enter massively in droves, and volatility would be through the roof. Options dealers would be delta hedging aggressively. Retail investors would be FOMO buying, and it would be a huge gamma squeeze that would be on repeat, 2020 all over again, except on steroids, the real MOAS. Again, this is how Archegos imploded. The swaps weren't properly collateralized, and when the prices moved, the banks were screwed. In this CFTC letter, this CFTC letter allows UBS to absorb toxic credit swaps quietly. Yeah. Say hi.
Hi.
Say, I love movies.
I love movies.
You love video games?
Yes.
I thought so. So there's going to be no clearing or margin requirements kicking in here, because if there were, it would be a huge problem for all market participants.
Yeah.
Is that right? Yeah?
That's right.
That's right. This disclosure here, this no action letter, shields these legacy exposures from public scrutiny and suggests... Hey, can you give me one moment, please? It suggests that the risk here, folks, is so large and so complex that the CFTC believes enforcing margin and clearing rules now, even now, would cause absolute chaos. This is a regulatory pressure valve release, folks. Not because the trades are fine, not because everything's going to be okay for UBS, but because they are way too explosive to unwind all at once. Huge shout out to everybody. My daughter and I wish you all peace and wealth and the absolute best.
Yeah.
I got to say, let's talk NWBO. But before we do, I'm not about done here.
Yes.
You can actually help stop this from happening
Yes.
to other stocks and even GameStop and AMC in the future. How? Well, with a little known upcoming stock brokerage called Lit Exchange,
Yes.
which plans to automatically route orders to lit markets, which actively prevents and deters market manipulation
Yes, that's why
that occurs through payment for order flow, right? Yup. And dark pools. Obviously, the Lit Exchange platform intends to harness artificial intelligence and swarm intelligence to analyze data from various sources, enabling users to make informed decisions. This includes crawling the web for the latest data and facilitating collaboration among users through think tanks in our real-time based chat rooms. This will protect retail from financial manipulation, to protect trades and equities from detrimental forms of financial manipulation, particularly those associated with payment for order flow and dark pools, because as you know, commission-free trades are far from free. Because in dark pools, equities prices are suppressed, trades are internalized, and synthetic shares are sold. So Lit Exchange is going to offer a seamless experience integrating AI enhancements, social media, and trading functionalities that will be accessible via the web, iOS, and Android applications. And we have also launched a founders program allowing non-accredited investors, that means regular everyday folks, the opportunity to own equity shares in the company through a Regulation CF offering on the FINRA regulated funding portal, Silicon Prairie. As you can see here, over 360 retail investors have invested $700,000 in the company already, and this is 100% organic. We have not spent a penny on advertising or marketing.
Didn't spend a penny, folks.
We didn't spend a penny. So if you're watching this right now, that means you're one of the few people in the world that even know about this opportunity. We will begin our marketing campaign here in May, and at which point it is likely that we will reach our final goal, and the funding founders investment program will be closed entirely. So if you have an opportunity, go ahead and do your due diligence. You will find all of the information on there: pitch deck, business plan, auditor reports, etc. On the Silicon Prairie funding portal. You can also see our filings on the SEC Edgar website, and so on. But let's talk NWBO, because in a bloody red market, guys, right now, NWBO is up 13%. Why? Why would that be? Well, maybe it's got something to do with the fact that they are suing Citadel Securities, Susquehanna, G1, and many other firms, including VIRTU, for driving down its stock price through a series of illicit trades, spoofing. And the stock has actually been delisted in the Bourse Berlin, which is absolutely wild. Actually, in the Stuttgart Exchange. So you can see here, this is from an attorney's website regarding biotech company, says Citadel, other big traders manipulated its stock price on the left. And on the right, you have a new screenshot that was just taken stating here that the stock Northwest Biotherapeutics has been suspended from trading on the Stuttgart Exchange due to the settlement issues in Germany. It is not known whether the stock will when the stock will resume trading. Told you guys yesterday or a couple days ago that I did go ahead and take a position in NWBO. They are a pharmaceutical company that is basically fighting cancer. They're doing a lot of cancer research and so on. And I am not advocating or insinuating or intimating in any way that you should buy, sell, or hold any stock, including NWBO. I do, however, believe that this is an extreme potential for this stock, even though it is a penny stock on the OTC markets, to make some significant moves, especially if the reason for it being untradeable due to settlement issues right now in Germany, it can be purchased in the United States. But because of the American depository receipts that are not settling in Germany, the Stuttgart Exchange, again, is not allowing people in Germany to buy the ADRs for it. I believe that means that there is an incredibly massive number of failures to deliver. And because they are not short or missing any filings per my analysis or for anybody else's that's done it so far, there is a lot of eyes on it right now. And if they're not missing any filings, and it doesn't really appear that they're at risk of going bankrupt at the moment, it is highly likely that a lot of the reason why they have been halted from trading over there is due to these failures to deliver. You can see here from the Bourse Berlin, they said, despite the transparency obligations on the home market, it cannot be prevented in all cases that disreputable market participants try to influence trade in fraudulent ways. Regarding the OTC, Bourse Berlin has made the experience that such influencing may not only take place at Bourse Berlin alone, but also simultaneously at the American trading venue. OTC markets are ripe for market manipulation. And with the fact that they have launched this lawsuit in December of 2022, and it is now April of 2025, we are potentially looking at a sort of settlement, maybe even worse. Maybe even the data is starting to come out, and some of this material non-public information is going to be made public. And Stuttgart Exchange in Germany, honey, can you hold on 1 second, baby girl? Along with the others, are expecting some massive volatility in NWBO when this information comes out even further. So I just wanted you guys to know about that. Ann J asks, is this good for us apes, Wolfie? I would say that both of these here, both of this news here between the CFTC allowing UBS to hide the credit swaps indefinitely and NWBO making it Germany making it so that you can't buy NWBO over there because of the settlement issues, are both extremely bullish for a lot of retail investors. Yeah, Wolfie says that those swaps are still on their books and they won't make them public. That's absolutely right, my friend. They will not make them public because if they did, it would be, again, a massive short squeeze of epic proportions. Everybody would pile in, and next thing you know, banks, brokerages, clearinghouses would be insolvent overnight, and a lot of retail investors would be millionaires and billionaires. And of course, that is the opposite of what these guys want. They do not want retail investors to succeed. They do not want to lose everything that they've worked for so long. But nothing lasts forever, folks. Nothing. The manipulation doesn't last forever. Their control will not last forever. And these swaps, although they can last for a long time and be rolled, will not last forever. Diver Down says, you got the great squeeze right in your arms right now, and you are absolutely right on that, my friend. I am absolutely blessed. Johan, my friend Johan and his wife said hello. Can you say hello?
Oh, hello.
What was that? JS Brando says, so if UBS can hide this forever, will it take a black swan event such as what's going on with the carry trade unwind and potential credit event to force them to cover the positions which they hide? JS Brando, there is a plethora of things that could force this unwind, a massive plethora, including the increased initial margin requirements of over 50% that Swiss regulators are currently calling for UBS to hold. And if that does come to fruition, well, let's just put it this way: the UBS would be having to fire sale assets regardless. And what do you think that would do to financial markets? It's like a powder keg. It's a powder keg, and the smallest spark could cause it to ignite. Yeah, Hakan Berglund said the reverse repo is under 55 today, and that is correct. The reverse repo today, the reverse repurchase operations program for the Federal Reserve has fallen from the highs of $2.55 trillion in 2022 down to only $55 billion today. If you've been following that closely, you would understand that this is massive in the sense that a reduction in the reverse repo operations indicates a huge lack of liquidity in money market funds, aka mutual funds. As such, the banking sector is the conditions in the banking sector are tightening massively, especially as the Federal Reserve, even though they've slowed their QT, continues to taper. So, yes. Pushing with powder says they are just hiding it, like GameStop, AMC, etc. I expect swap moves coming with a push in June. I don't know. I can't say exactly when, but let's put it this way. When swaps have to be rolled, we've seen what happens. When swaps have to be rolled, we've seen what happens. Even when something is as simple as a man by the name of Roaring Kitty puts out a tweet or does a live stream, we've seen what happens on stocks like AMC and GameStop. That is just a small indication of just how volatile this can be.
It's so bad.
Say cheers, my friends.
Cheers, my friends.
Say, I wish you peace and wealth.
My wish you peace and love.
Brah. Okay, baby. All right, folks. I think that's about it for now. Have a great day. I'll see you guys tomorrow. Let me know if you guys have any questions. And if you haven't yet had the chance to get in on Lit Exchange, shoot your shot. Cheers.